It's been a shorter week, but that has taken nothing away from the activity in financial markets this week. It has actually been a good week. At its peak, the London stock market was up close to 7% on the week, but as we sit here on Friday morning, ahead of the non-farm payroll figure that is due out in the US this afternoon, we have seen a little bit of weakness in the market, so it looks like we may be still up 3 or 4% by the end of the week, depending on that market. Now, what has driven this renewed optimism for equities this week, I sense, comes back to the speech that was given by Ben Bernanke last week at the Jackson Hole conference. Now, whilst markets had some anticipation built in that he would say something on QE or further stimulus, it's fair to say that whilst he didn't commit to anything, the fact that he spoke about a 2-day conference in September, September the 20th and 21st, rather than a 1-day conference, suggests that they are looking at the range of tools that they have if further stimulus is required. And I think the market has taken some optimism there that they are ready to pull some levers if as required. So some of the charts we'll look at today will indicate why he may need to do that. The first of all, though, this is the FTSE 100 chart that we're looking at here, and we can see here this sort of extreme choppiness as the market has reacted to this very sharp pullback. But as I say, the optimism this week is starting to suggest that we're putting some bottom in place in that chart, and some optimism, as I say, creeping back into equities. So a good week, and let's hope we can see some build on that over the course of the next week. Now, in terms of talking about Ben Bernanke and some of the reasons why he may need to come in with some further stimulus for the US economy, this is the consumer confidence chart. It dates back to, as you can see here, 2005. So you can see how quickly consumer confidence deteriorated back in the sort of early part of the recession. What has concerned markets is the speed of the decline in consumer confidence again. Now these numbers have been also supported by many numbers in terms of manufacturing, ISM surveys, and so some of these forward indicators at the moment are concerning people that the US may be heading back into recession next year. And as I say, at the moment, and this is just a guide more for traders, any bit of bad news that comes into the market generally gets stock prices moving ahead, because on the basis that it compels more the idea of stimulus coming into the market later this month. So as I say, we've had some pretty poor data, and consumer confidence for me was the standout. The non-farm payroll data that is due out is clearly going to be very closely watched this afternoon. One sector that has responded very favourably to the brighter optimism for equities this week has been the banking sector. Now, clearly it's been one-way traffic for a long period of time now, but I'm just going to sort of quickly demonstrate that Lloyds and Barclays have responded quite positively this week. This has been where the action has been. This is where traders have been positioning in the financial sector. It was aided by some further confirmation at government levels ahead of the Vickers report that it may be post this current term for the government before we see any imposition of restrictions on the banks, and that was treated with some favourable response in share prices. One area that I keep a constant eye on as potential waves of fear do continue to impact on markets over a period of time. The Europe problem hasn't gone away. At the moment it's just been put to bed, I suspect. But this is the chart of the Italian bond yields, and the next chart is the chart of the Spanish bond yields. And on both charts you can see the decline that came in when it was seen that the central banks were going to be buying some of these European bonds. And that was obviously a well-received move. But I'm just, at the moment, just indicating that we're seeing some creep back up in yields at the moment. We saw auctions this week in Europe for Spanish bonds. They weren't particularly well covered. I don't think anyone came out thinking they were a roar-away success. And just seeing some of the creep up in yields at the moment, we're certainly not in areas that cause concern, but it is a chart that I have fairly sort of close to the top of my pile to keep an eye on, because it will, as I say, if it continues that creep, start to bring a little bit of negative feedback to the market. Finally, one sector note that we've produced this week is to buy the mining stocks for a number of reasons. Broadly, mining stocks were hit pretty hard in the August decline, as we can see here by the chart of Billiton, but I'm also looking here at Rio Tinto and also Xtrata. The charts do actually follow a very similar typical path. If we are looking at slower growth, naturally commodity stocks usually get hit. Our argument, which is driven by that decline in stock prices, that we think it's been oversold. We're not necessarily pricing in a slowdown on the magnitude the mining stocks had priced in at the middle of August, but we also think there are some good supply and demand arguments as to why commodity prices will continue to hold quite firmly. So we think it's time to buy the mining stocks, and as always, speak to your broker if you want a copy of that note.